Hello and welcome to our International Economics course online. Now we're going to discuss Chapter 10, the balance of payments. The balance of payments is an accounting record at the national level that tracks all international transactions, particularly focused on the exchange of goods and services and income transfers. The balance of payments consists of three main accounts: the current account, where are recorded all the transactions of goods and services, as well as a portion of income statements; the capital account, which is the least relevant of them all, where mostly is tracked the exchange of income between governments at the international level, and foreign aid, for example. And lastly, the financial account, which basically reflects the flow of money for all the transactions going on in the current account, as well as the exchange of currency and investments between financial institutions such as central banks, as well as individuals. The balance of payments follows a double entry accounting method, meaning that for every international transaction there are two records, a credit and a debit, so that at the end, the common T in accounting, the credits equal the debits. A typical credit includes, for example, the export of goods and services, transportation and travel receipts, income received from investments abroad, gifts received from foreign residents, aid received from foreign governments, and investments in the US by overseas residents. A debit transaction, on the other hand, typically comprises the record of merchandise imports, transportation and travel expenditures by US citizens when they go abroad, income paid on the investments of foreigners, gifts to foreign residents, aid given by the US government, and overseas investments by US residents. So pretty much a credit is associated with money coming in and a debit with money getting out. The balance of payments account must always be in balance. The credits must equate the debits. There is a surplus when the credits outweigh the debits. The balance of payments shows a surplus when we, for example, sell more to foreigners than the amount we buy from foreigners, and a deficit when the opposite occurs, when we buy more from foreigners than we sell to foreigners. The balance of payments captures the monetary value of these international transactions. Transactions in goods, in services, income flows, and unilateral transfers. Transfers that are done without receiving anything in return. Think about, for example, a foreign citizen working in the United States sending money back to his family in another country. Or think about a US citizen working abroad sending back money to the US for his family. The balance of payments, in addition to the main accounts that I referred, namely the current account, the capital account, and the financial account, as further subcategories. For example, within the current account, we have the merchandise trade balance, which is basically the goods trade balance, if we are exporting more than what we are importing, the services trade balance, and then this can be aggregated into the goods and service balance. The goods and service balance tends to be loosely used as a proxy for the current account balance. However, one must know that the current account balance, in addition to the balance of goods and services, includes as well the balance in income flows. Income receipts and payments. These are net earnings, dividends, and interest on U.S. investments abroad, earnings on U.S. investments abroad minus payments on foreign assets in the United States, meaning paying to foreigners the earnings from their investments in the United States, and as well as compensation of employees being received in the United States or being sent outside of the United States. The unilateral transfers are pretty much a private transfer payment or a governmental transfer payment without receiving anything in return. Typically, these comprise gifts. And therefore, the current account balance includes the balance of goods and services, the investment income, and the unilateral transfers. This is the comprehensive composition of the current account balance. Even though people tend to use just the balance on goods and services as a proxy for the current account balance, because in reality, the current account balance is mostly dependent on the balance of goods and services. The capital and financial account captures the capital and financial transactions in the balance of payments, all international purchase and sales of assets, the private sector and official transactions. The private sector financial transactions, for example, comprise direct investment, the purchase and sale of securities, and bank claims and liabilities. The official settlements transactions shows the movement of financial assets among official holders, the official reserve assets, liabilities to foreign official agencies. So these are pretty much just transactions between, for example, central banks and other institutions at the government level. Let's now look at the data for the United States. The textbook is somewhat outdated, so we're going to look at the recent published data. So this data is downloaded directly from the Bureau of Economic Analysis. The link is provided in Canvas below the video. This is the link you use to get the balance of payments, and this is the link you use to get the international investment position, which is another accounting record that we're going to look at. So far we have just discussed the balance of payments, and that's where you get it. In particular, the one we're going to be looking at is this first item from 1960 to the present, data on international transactions. I already did some graphs, so here is the data set that was downloaded. I downloaded annual data for all the years available, which are from 1960 up to 2017, and you can see here the several rubrics that comprise, for example, the current account, the rubrics of the capital account, and the rubrics of the financial account. Note that the data is displayed in millions of dollars. So in 2017, the total amount of exports was about $3.5 trillion, whereas the total amount of imports was $3.9 trillion. So the difference between these two numbers is what gives us the current account balance, and therefore you can see that this number is about 450 billion. In the year 2017, the export of goods alone and services comprised 2.23 trillion. The item related to income here is broken down into primary income receipts and secondary income receipts. Adding these two numbers, it's about 1.1 trillion. So most of the exports are of goods and services. When it comes to income, corresponds to about a third of that figure. The same subcategories are displayed for the import side. So when it comes to the capital account, we have about 25 billion of transfer receipts and 42 million only of transfer payments. The financial account. In 2017, the net US acquisition of financial assets excluding financial derivatives was about $1.2 trillion, whereas the net US incurrence of liabilities, excluding deals with financial securities, was about $1.5 trillion. Okay. So this deficit corresponds to the deficit in the current account. When we look at financial securities alone, there is amount to about $23 billion. And this statistical discrepancy, which is about $92.5 billion, this statistical discrepancy is the difference between all the credits and debits that we don't know to which category to allocate. Remember that the credits must equate the debits, and if they don't, whatever is the amount of that discrepancy shows up here in the statistical discrepancy item. Then the data from the Bureau of Economic Analysis does some treatment for us. So it shows us the balance on the current account, line 1 minus line 9. So we're talking about those computations we were discussing. Line 1, the total exports of goods and services and income receipts, minus the imports of those items. So the current account balance ends up being $450 billion. If we look at goods and services alone, that deficit is $552 billion. The trade deficit, when we look at goods alone, is about $807 billion. But we do have a surplus in the balance on the transaction of services. So what is primarily driving our trade deficit is that we buy many more goods from foreigners than we sell them. Because when we look at the services sector, they are doing quite well. They have a surplus that is about 1/3 of the deficit on the goods. So partially our trade deficit is offset by the surplus that we have on the trade of services. And this is typical of a developed economy because, as we discussed in previous chapters, a developed economy is typically characterized by a predominant service sector. That's true for the US and most developed economies. By contrast, in less developed countries, the agricultural sector tends to dominate, whereas in developing countries, the manufacturing sector tends to dominate. In developed nations, the service sector tends to dominate. The balance on primary income is positive, so we have about 221 billion surplus. However, in secondary income, it is a deficit of $118 billion. That secondary income corresponds to those unilateral transfers we were talking about earlier. So Americans working abroad send back home $154 billion, whereas foreigners working in the US send out $273 billion. Hence, the deficit in that secondary income rubric. The balance on the capital account is positive of $24 billion, meaning that we receive, for example, more gifts than the ones we give out. The net lending, so or net borrowing, if it was lending if it was positive, or borrowing if it is negative, the balance from the current account and capital account, it's about $424 billion, and from the financial account is about $331 billion. Let's look at the evolution of this data throughout time. So this is the data plotted for the current account balance since 1960 to 2017. For example, the current account balance in 1967 was approximately the same as the balance on the goods and services alone, and that amount accounted to $2.6 billion. The curves are coincidental at that point. The values are very close. And see that the pattern is always identical when we talk about the current account balance as a whole or the balance on goods and services. The most meaningful discrepancy occurs only since 2009, where the current account balance is significantly different from the balance on goods and services. The orange one is the current account and includes the income transfers, whereas the blue one is just the balance on goods and services and doesn't include the income transfers. So the income transfers help to alleviate the negative impact of the trading goods and services that we have. We're buying much more than what we sell. But prior to the Great Recession, the 2008 financial meltdown, they were very close, these values. Coming back to the evolution of these balances, note that in the 70s, that's when we start touching negative grounds, the negative balances. Right? And remember that in 1973 we had the famous oil shock, adverse oil shock. In 1972 we had the break of the gold standard, meaning that the dollar was no longer pegged to gold, no longer backed up by gold. There was instability of the markets, and in 82, at the 80s, is when it starts the liberalization, the strong liberalization of the markets in the United States. The Reagan administration starts shortly after, and the current account balance went significantly negative at that time, coming back in the early 90s to almost positive territory, but since the 90s, the longest expansion of the United States is associated with the biggest aggravation of the current account balance. So, how come? Well, this is a typical pattern that we observe in rich nations, which is the richer a nation gets, the more it buys of everything, including foreign-made goods. If the other nations, our trading partners, are not getting as rich as us, they don't buy as much as we do. So we keep on having these increasing disparities between how much we buy from them and how much they buy from us. So ironic, this corresponds to an economic boom. Note that on the other hand, when we have a meltdown of our economy in 2008, the trade balance got better, got less negative, and that's because we became poorer and therefore we were buying less of everything, including foreign made stuff. As the Great Recession started to alleviate, we came back to buying more goods and services. So this is a matter of consumer behavior as well, consumerism. Relatively to other nations, we consume a lot. And from that consumption is a lot of domestic made goods, but as well a lot of foreign made goods. Not surprisingly, the savings rate in the United States is quite low when compared to other nations. Let's look at the evolution of the trade in goods alone. As we talked about earlier, this is the main driver of the current account balance. So in the 70s, we started buying increasingly more goods and services, and primarily after the 90s, the IT boom, right? The red line depicts our behavior in terms of buying from foreigners, and the green line depicts our behavior in selling to foreigners. So we are selling currently at historical highs, right? But also buying at historical highs. And note that the difference between our exports and imports has been increasingly greater. That's why our current account balance has been increasing. Let's look at the behavior in services. So we have the blue line for the balance, the gray line for the imports of services, and the orange line for the export of services. Note that we never exported so much of services. This increase has been the slope. You see the differences in slope. The trend was pretty much at this rate. That's how steep it was, up from the 80s up to the 2000s. And then in the 2000s, the trend became, the slope of the trend became significantly steeper. That's how rapidly we are increasing our exports of services. So a significant portion of the labor force works in services, and they are doing increasingly better. In this context, it is worth it to look at the employment of the US labor force per sector. So this is recent data published by the Bureau of Labor Statistics. This table 2.1 shows the employment by major industry sector in the years 2006-2016 and the projections for 2026. So let's look at the year 2016. There was a total of 156 million people working in the United States. Out of those, 20 million were working in the industries that are characterized as goods producing sector. This includes mining, construction, and manufacturing. Note that mining accounts for about 626,000 workers in the United States as a whole. Construction about 7 million workers, and manufacturing accounts for 12 million workers. What about the services sector? Well, the services sector in the United States employs the vast majority of the workers, 125 million workers. That's how predominant the service sector is in the United States. So, out of all these industries, of the service sector, like utilities, wholesale trade, retail trade, transportation and warehousing, information, financial activities, professional and business services, educational services, healthcare and social assistance, leisure and hospitality, other services, federal government, state and local government. Most people are employed in the professional and business services, healthcare and social assistance, state and local government, leisure and hospitality, and retail trade. When it comes to the agricultural sector alone, it represents merely 2.3 million people in the United States, out of which 850,000 are self-employed in the agricultural sector, and 1.5 million receives wages and salaries in the agricultural sector. So obviously, the US is a service economy, and it's a good sign that the exports have been increasing at a significant pace for this sector that we are increasingly specialized in. Our negative trade balance when it comes to goods and services, it's also associated with our relatively low employment in the sector of goods and services. Now, this does not mean that we are producing less goods and services than ever. In fact, as I showed you before, the US manufacturing output is at historical highs, whereas the employment in the manufacturing sector is at historical lows. Technological innovation and automation both tend to replace humans. That's what advanced economies do when it comes to the manufacturing of goods. We take the people out of the production line and put machines and robots in the production line to achieve higher levels of efficiency. We don't need a person to dig a hole. We have a machine that can do that for us. Here is the data from the Federal Reserve. Manufacturing sector real output. So this is the data from the first quarter of 87 to the first quarter of 2018, and we are operating at historical highs, almost as much as the fourth quarter of 2007. And at the same time that we are producing at historical high levels, this is the quantity of output produced, we are employing at historical lows. We used to employ at the peak year of first quarter of 89 51% more than we were employing in 2009. Note that the index, the number of people employed in the sector have been indexed, and the reference point is 2009. So assuming that 2009 was 100, look, 100 in 2009, in 88 we were employing about 50% more people than in 2009. And compared to 2009, nowadays we are employing about 6% more people. Nonetheless, this number is quite low compared to what it used to be prior to 2001. But despite the fact that we are employing low levels of people in the manufacturing sector, we are producing much more than ever before. Look at the production level in 88 compared to the current production output. This is technological innovation and automation typical of developed economies. Now coming back to the textbook materials, the next topic in the agenda is to discuss why a negative trade balance usually means that the country is a net borrower, and why, conversely, trade surplus means that the country is a net lender. This has to do with the national accounts identity, and that's what Carbau is trying to illustrate here on slide 25, and we're gonna do some derivations by reviewing some material that you learn in Principles of Economics to substantiate the claims made on this slide number 25. The national accounts identity that you learn in Principles of Economics, if it's shown just like this, where income, whatever is produced in a given nation, it's equal to whatever is consumed, invested, and purchased by the government, it refers to a closed economy. If it considers as well the exports and the imports, then we're talking about an open economy. When written in this format, the national accounts identity is being expressed to what we call the expenditures approach. Whatever is produced, so this is the supply side, it's equal to whatever is demanded. Now let's work out this equation to get at the point that Carbau is making on slide 25. It's merely rearranging the terms. So if we move to the left-hand side of the equation, we move the consumption, let's move the government purchase, and keep the remaining on the right hand side. So on the left side of the equation we have whatever is produced minus what is consumed by the households minus what is consumed by the government. If anything is left, this is what we call national savings. So national savings is equal to investment plus the difference between exports and imports. Now let's move the investment to the left hand side. So what we have here is the difference between what is saved and invested must equate the difference between what is used for exports and what we get through imports. The difference between exports and imports is what we typically refer as net exports, where net exports is a proxy for the current account balance. Because as we learned from the data, the current account balance is primarily driven by the exports and imports of goods and services. So, if savings are greater than investment, this implies that net exports are positive, meaning that the country is a net lender, meaning that the country has a current account surplus. And this is, for example, the case of Germany and the case of China. if savings are not enough to satisfy the demand for investment, then net exports are negative, meaning that the country has to borrow from abroad. So the country is called a net borrower. This also means that the country has a current account deficit. And that's the key idea that Carabao is trying to portray on that slide, is referring to a deficit. But it shows it in a quite interesting way, because he manipulated this equation in order to get to one he put on the slide. How? Because these savings, national savings, which I'm using now just any, which I'm using just S here, it's equal, as we mentioned over there, to income minus consumption minus government purchases. Now let's add taxes to the right hand side of the equation and subtract taxes from there. So let's do like this, so that the equality still holds, because we're just adding and subtracting taxes. Taxes are paid by the households and are a revenue for the government, so collected by the government. They offset each other because they are coming from within the economy anyway. However, if we rearrange the terms, if I do the income earned minus taxes minus consumption, this is what we call private savings, the savings of the individuals. Whatever income they get, they pay taxes, and then they consume goods and services. If anything is left, that's the amount of private savings. On the other hand, we still have this T and G to deal with. So T minus G is basically the governmental savings, also known as public savings. The revenue of the government is the taxes they collect from the people, and then they use it to consume goods and services, which are captured by G, government purchases. So this difference is the governmental savings. Therefore, national savings can be broken down into private savings plus public savings, also known as governmental savings. Okay. Now, to get the equation that Carabao shows in slide 25, we need to keep taxes and government purchase, these two variables there. So we're coming back to breaking down the government purchases into T minus G. Okay. Let's call this equation 2, and let's go back to this equation and call it equation 1. So what I'm going to do now is plug equation 2 into equation 1. Plug equation 2 into equation 1. And by doing so, we get, note that this is what I'm using, national savings, right? Here without the subscript. Let's keep it without the subscript because we're going to refer to a part of it as private. So the national savings there, I'm going to replace with this. and then I still have the minus I equal to net exports. Okay. Then Carbow on slide 25 wants to talk about a trade deficit, meaning that this is going to be a negative number. So now multiply both sides by -1. So what you're going to get? Negative SP, private savings, negative taxes, positive government purchases, positive investment, and negative net exports, right? Trade deficit. Now let's rearrange this the way it looks in the slide. So in the slide starts with G, it's there, and then it puts minus T. And we know that these two dictate the governmental savings, forcing it to be at the deficit. Then we have what is left. We have the investment, and we have the private savings here, which is equal to the trade deficit. So this is the equation on Carbow on slide 25, and that's how we derive it. We have the trade deficit from the government, we have the difference between how much is invested and how much is saved by the private sector, right? Private investment and private saving, and the current account deficit. So the current account deficit is equal to this relationship as portrayed on slide 25 of Carbow. So we have derived how Carbow arrived to this equation, and now let's talk about in more granular detail and based on Carbow insights the meaning of a current account deficit. These slides 26 to 20 we already discussed it when I was showing the data from the Bureau of Economic Analysis. Let's look at slide 29. So the US is experiencing a consistent and persistent trade deficit, particularly since the 1980s, since the Reagan administration till nowadays. And the paradox that is noted here is, well, if we have a current account deficit, then we are basically borrowing from foreigners. And we are selling our assets to foreigners because we are consuming more than what we produce. In order to buy that extra, we have to finance it, and that financing is either by borrowing from foreigners or selling them our stuff. So the US, with persistent accumulation of deficits in the current account balance, means that we are persistently increasing our national debt, and we end up as a large net debtor. The paradox here is that the US residents have consistently earned more income from their foreign investments than foreigners earn from their larger US investments, but they keep on investing in the United States. And I may ask why? Well, the US is perceived, relatively to the other countries in the world, as a safe haven. If any country is going to go south, they expect the US to be among the last ones and the one experiencing a less severe collapse. So they feel safe in investing their money in the United States. Any investor has a diversified portfolio, and a portion of it is for less risky investments, and a smaller portion of it is typically allocated to risky investments. So where are the safe havens for that portion of your portfolio that you want to keep safe or relatively safe? Well, the US has been a major destination of, for example, Chinese savings. China is among the largest holders of US debt. Let's look at the data from the US Treasury. That's where we are at now. This link is shown in Canvas below the video. So as of April of 2018, China, among the foreign holders of US debt issued by the Treasury, so this is primarily government debt, they are the foreign country that lends us the most, and about $1.2 trillion. Japan is the second, with about $1 trillion. And then, relatively far away, lending is much less than China and Japan, is Ireland, with $300 billion. Brazil, 294, UK, 262. So if China was to stop lending us money, would be a similar effect as Ireland, Brazil, United Kingdom, and Switzerland simultaneously deciding to stop lending us money. So this would be a severe constraint. In total, foreigners have lent the US government about $6.2 trillion. The relevance of maintaining good relationships with China also depends on the fact that they are our major foreign lender. Hence, creating a trade war with China has made previous US administrations officials quite nervous about it, and they attempted to prevent it, because a significant disruption in political relations between China and US might create a relatively meaningful dent on the US finances. Now, how big is this amount lent from China relatively to the total debt issued by our government? This contest is worth it to look at how indebted other countries are. I am at The Economist magazine. They publish this global debt clock, collecting data from all countries from all over the world, and they focus just on government issued debt. So no, the US is 20 trillion. Their estimate for the global government debt is 60 trillion. So the US accounts for a third of the world global public debt. However, this is all relative because it depends how much money we make. So if I make $10,000 a year, if I'm indebted $5,000, that's 50% of my income. It's quite severe. But if I make $100,000 a year, then those 5,000 will be merely 5%. So the more I make, the more I can borrow. So in the US, the latest data that they have here shows that the public debt represents 93.6% of the GDP. But for example, if we look at, I said Japan, that number is 261%. So people will be more easily reluctant to lend money to Japan than to the United States. Let's look at France. It's pretty much like the US. The UK too. Germany slightly lower, 86%. What about Portugal? 159%. That's why Portugal has relatively some trouble in financing itself through the issuance of debt. Italy 122, Greece 147. The US is not performing badly when we look at this effort ratio, the percentage of debt relatively to GDP. Therefore, foreigners still quite comfortable in lending money to the US because its ratio of debt is pretty much within the norm of Western societies and not as bad as Japan, for example. Carvalho proceeds by talking about potential policies to reduce the deficit, slide 32. So its recommendations are basically to implement policies that stimulate foreign growth, not domestic growth, and an increase in national savings. Remember that through the national accounts identity, savings minus investment is equal to the current account balance. So we can ameliorate the current account balance by increasing our savings to an amount greater than our investment, or at least reduce the gap between how much we save and how much we invest so that we don't have to borrow from foreigners to do investment. This reference to stimulate foreign growth has to do with the fact that, as I showed you when we were browsing the data, the richer we have been getting, the more we buy of everything, including foreign-made stuff. And the pace at which we are increasing our purchases is much faster than the pace at which other countries are getting richer and buying more stuff, including the stuff that we make. So if we stimulate foreign growth, we're basically making our foreign consumers of US products richer so that they can buy our products as well. That has been one of the key directives in foreign aid policies through developing countries. One of the positive spillovers of the betterment of living conditions in foreign countries is that as they become richer, they buy more of everything and may become potential customers of the more expensive products produced and sold by the most developed nations. Coming back to the issue of foreigners investing much more in the US than we invest on them, it's now the time to look at the balance of the international indebtedness, which is proxied by the international investment position of the United States. I'm gonna explain the data shown on slide 36 using the most recent statistics disclosed by the Bureau of Economic Analysis. Table 1.1 is called the US net international investment position at the end of the period, and I downloaded annual data. The US discloses data from 1976 up to 2017. The US net international investment position is negative $7.8 trillion. This is how much more foreigners invest in us compared to how much we invest on them. The US owns in foreign nations about $27.6 trillion worth of assets. Foreigners own about $35.5 trillion of US assets. The difference between these two numbers amounts to that $7.8 trillion negative position. So this is another motivation to keep good relationships with foreign nations. What if they were to do a fire sale of all their assets? Now let's look at the evolution of this data throughout time. And in the Excel file I made available on Canvas, this Excel file, there's a plot of the data. The blue line shows the balance, the green line how much we own in foreign nations, and the red line how much foreigners own in the US. See that the pattern is pretty much the same in assets and liabilities, meaning that we have been owning increasingly more foreign assets, but foreigners are also been buying increasingly more domestic assets. The pattern of the difference has changed after 2006, 2008, the Great Recession. So what we have seen was up to then the balance was pretty much negligible, hovering around zero till pretty much 1996, and then where we had at that point a minor negative position of 328 billion. I say minor because relatively to today that's a small amount, as now we have a negative position of 7.8 trillion. So in 96 it was just about 328 billion. And this discrepancy became wider here because again of the idea of the US as a safe haven. So if foreigners want to park their money in a relatively safe destination, they buy US assets. This is positive in the sense that helps whoever the US owner was of that asset by providing them with a cash flow for their sale. But on the other hand, any rents that those assets create are collected by foreigners. It's worth to mention that this is not necessarily a bad thing. Why? Imagine that this is the result of foreign companies buying factories in the United States and moving production of whatever is their product to the United States. So even though the foreign companies own the plant and equipment, because they are operating in the United States, most likely they are creating jobs and employing US workers. So it's a win-win situation in that sense, given that at least part of their earnings remain in the United States, even though a significant portion of their earnings is sent to their home countries. This is the dilemma that developed nations experience. An increasingly globalized world, the free movement of capital, the free movement of goods, leads the world as a whole better off. And even though everybody is experiencing increasingly higher standards of living, on average, remember that world poverty declined from about 30% of the world population living under poverty in the 80s to about 9% nowadays. And this is due primarily to international trade, the movement of goods, services, capital, and people.